Welcome. You're listening to ElevateTALKS, a show designed to support the education and leadership goals of today's bankers. I'm your host, Michael Delucchi, and it's my pleasure to join you on your professional and personal journey to the top. Hello, everyone. Today's guest will be speaker, instructor, and writer, Mr. Dev Strischek. Dev is principal of Dev Risk Advisory Group and engages in consulting, speaking, and training on a wide range of risk, credit, and lending topics. Today, we're going to hang 10 with Dev and talk about surfing the business cycle. Is it high tide and high time to go with the flow? How much longer will this expansion really go on? And what should we bankers be doing to prepare for the slowdown? So let's find out what we could do to ride these economic waves. But first, let me tell you a little bit about Dev. As former SVP and Senior Credit Policy Officer at SunTrust Bank in Atlanta, he was responsible for developing, implementing, and administrating credit policies for SunTrust's wholesale line of business. Prior to SunTrust, Dev was Chief Credit Officer for Barnett Bank in Florida and had stints at other banks in Kansas City and Ohio. A graduate of The Ohio State University and the ABA Stonier Graduate School of Banking, he earned his MBA from the University of Hawaii. Today, Dev serves as an instructor at the Stonier Graduate School of Banking, the Southwestern Graduate School of Banking, and the American Bankers Association's Commercial Lending School. His school, conference, and workshop audiences have included participants drawn from the ABA, RMA, the OCC, the Federal Reserve, FDIC, and the AICPA, just to name a few. I first met Dev almost 10 years ago through RMA, where Dev is a regular speaker, writer, and past chapter president and RMA national chair. Dev has spoken at many of the programs and conferences I've managed over the past few years, and apparently moonlights as a lifeguard, since today he's going to help us stay afloat and avoid today's economic undertows. Dev, welcome to the show.
Well, thank you, Mike. Looking forward to talking with you.
Excellent. Okay. So tell us, Dev, what exactly is a business cycle?
The business cycle, the short and long of it is that it's the ups and downs that most of us have lived through during our lives. The economy looks good, gets better, and then it goes into kind of a slide. And what we're talking about is the what we used to call the early recovery. Then it becomes the expansion, then the boom, then the contraction, and then the recession.
The recession, right. How does lending and borrowing change over the business cycle, Dev?
Well, that's the fascinating part of it, Mike. We bankers don't have much that we can do about it. We rely on the Fed and the government to help us in and out of recessions, but our borrowers are in the same predicament. And the way it works is that as we climb out of the recession into what they call the recovery period, this is where, by this point in the cycle, borrowers have used up most of their liquidity to stay alive. They need some money to prime the pumps, and this is when the working capital lines of credit start rolling out. And the working capital lines of credit help borrowers buy the inventory that they need in order to generate sales. And if they sell on credit, then they need a little bit of time to collect the receivables. And if all things go well, when you aggregate this and more borrowers have recovering sales, then we kind of roll into the expansion. And this is when our borrowers decide we've been running on fumes to date. Our equipment needs to be upgraded. We need to increase the size of our warehouses, and the nature of the type of borrowing shifts from what I would describe as short-term seasonal borrowing to permanent working capital to finance the growth, that long-term growth, 2, 3, 4, 5 years. And it's a combination of both more permanent working capital, receivables and inventory as they broaden their inventory, as they increase their sales to to borrowers, customers who may not be quite as credit worthy as the ones they had before. The cash cycle lengthens a little bit. The capital expenditures are bigger. And of course, when you build a new factory, build a new warehouse, you don't get it 100% occupied right away. So what begins to happen is you get a little less bang for the buck. until finally you get the productivity back up to where it is. By this time, supply has caught up with demand, and then the revenue growth in the economy begins to slow down a little bit. Wages start rising. You can't pass the cost on as much as you used to be able to do, and you get this sort of peak, the expansion peak, and that's where most economists would say we are right now. And so, as we begin to go over that peak into the slide, the contraction, this is where borrowing now shifts to we're not going to buy as much inventory. We're going to try and run it down. We need to have a little more time to collect the receivables from the slower paying customers until finally the demand contracts so much that we really do fall into a declining revenue, declining GDP, and borrowers are back at that point where they're essentially borrowing to cover their operating nut. And by that I mean basically, paying for the utilities, paying the rent, until finally you slide back into that recovery and we start the cycle all over again, about where I started 4 or 5 minutes ago.
So, Dev, what industries are vulnerable to the downturns in the cycle?
Good question. And let me start it off with construction. It's probably one of the most sensitive industries that we have. But particularly in as we slide into recession, the first thing that people give up on is buying new homes. And we'll stay in an apartment or we'll put off buying a home. The construction of new single-family residences, or even new multifamily, you have to put carpeting into it, appliances, refrigerators, stoves, washing machines, dishwashers. And that's the next industry that tends to be very, very cyclical and very vulnerable. The most of the carpet in the United States is manufactured just up the road from me, where I am here in Atlanta, and watching its industry revenues rise and fall, it's a pretty good indicator that the recession may not be that far away. Down as you move down the list, the other pieces of the construction industry that begin to fall apart, of course, would be materials: lumber, stone, clay, cement, metals, steel, copper. And when you add up all of the connective industries to construction, it's a very large share of our economy. And that's the case for many countries. Let me toss out China. One of the reasons for their decline in GDP recently has been generally a fall off in construction activity. Everybody has figured out that the way to juice up the economy is to encourage construction. And when you run out of construction projects, that's when you start getting a sense that maybe the recession is getting a little bit closer. And the other industry that tends to be fairly sensitive would be the transportation industry: trucks, autos, transportation equipment in general.
Gotcha. What about commercial real estate?
Commercial real estate, of course, given that I've talked about residential in the form of multifamily and residential construction, but certainly the general commercial real estate market starts dropping off as well, simply because these are bigger purchases for the most part and depend on a lot of investor money. And as investors start seeing a decline in the general economy, I used to use shopping centers as an example. That's not a particularly hot prospect right now. But
Right.
As you see a decline in overall consumer spending, the whole retail sector begins to pull back a bit. And along with retail commercial real estate construction, you also have a pullback in some of the other related construction, warehousing. Maybe I don't need as much warehouse space to hold the consumer products, since consumer construction or consumer purchases are off. And as you work your way down through the list, then you run into things like hotels. And hotels are extremely sensitive to recession, simply because hotels depend upon tourism and business travel. And what a surprise to no one that as we begin to go into a recession, people don't travel as much, people don't go out on business trips as much. And when you see the hotel market slide, then you start seeing new hotel construction begin to dry up. And I'll mention this because I happened to come across it a couple of weeks ago that we're running into an oversupply situation in what I would describe as those mini storage facilities that you see popping up all over. Unfortunately, they have been popping up all over, and they're not getting the kind of occupancy that you would have expected. And when you consider that during this 10-year period, we're now in the longest recovery, longest expansion in the history of the United States, the overall office market has changed substantially. We don't require as much in the way of space per employee as we used to. So office demand is down a little bit. Overall, manufacturing is not using up as much space as it used to. And the bright spot had been these shared working spaces, but of course the collapse of WeWork in its IPO threw a monkey wrench into that market. And the other big piece of commercial real estate that had been hot was the what I'll call the senior housing market. And what a surprise, I discovered that people are not retiring in the numbers that had been thought or been projected. People are still working past their 50s, their 60s, into their 70s. They're not ready to be put away in an old folks' home. And so that market has also not turned out to be as lively as people thought it would be. So when you add to that again, the investor money is looking for a high return. It is running out of things to look for in the commercial real estate sector.
Right, that makes a lot of sense. Well, I was just in downtown San Francisco yesterday for a meeting, and there I was at it wasn't a WeWork space per se. It was just an office space that had extra space and offices within it, and it didn't have full capacity for the company. So they put it online as you could rent it by the hour. And so you're seeing there's not just the WeWorks going down, but you're seeing some of the larger office spaces downtowns in metro areas are trying to kind of do the Airbnb of the offices, where they're renting out their extra offices online for hourly and monthly tenants.
Well, and you happen to be living in a market that is woefully short of residential space. So one of the few bright spots in residential construction certainly has been California and the West Coast, and to some extent some of the urban areas on the East Coast, Boston, New York. But for the most part, the rest of us are pretty much full up at this point.
Mm-hmm. Well, and to that point, from a business cycle, how does that affect geographically? Does it have trends where it spreads to metros first, rurals first? How does that kind of work on a business cycle that you've seen?
Well, that's an interesting point. I grew up in central Ohio in a rural area. And the one thing I can say is recessions come and go, but in farm areas, you sort of get through it. But the China trade issues have created havoc in many of our agricultural areas. The soybeans no longer being sold to China, and when you look at the rest of the crops, the floods that we had during the summer have really devastated the growing season. Corn, soybeans, wheat. And of course, there's not nearly as much demand. So you get these places in the United States that have been impacted, a combination of trade and the trade wars with China, and then, of course, the unusual rainfall and poor weather. And so this creates a different sort of recession, although one could argue the ag sector has been in recession for several years now, and the China trade wars have not helped. And again, going back to manufacturing, the so-called Rust Belt has gone through its ups and downs. And when you start thinking in terms of Buffalo, New York, Cleveland, Ohio, and even over to Chicago, up into Wisconsin. Again, these are areas that are heavily tied to what I'll describe as the auto sector, trucks and cars, and even that sector has probably peaked. And so you get a kind of recession related to that industry. As you move down into the southeast, we have all kinds of interesting things at play here. And of course, the hurricanes create a weather issue for us. The cheaper cost of labor has turned southeastern United States into a automobile manufacturing center itself. But again, we're reaching that point where auto sales have peaked. And then if I move over to Texas, and it's ironic that back in the 1980s, Texas was the poster child for the recession of the early 80s and the late 80s, simply because of the overinvestment in real estate. Ironically, Texas, leaving out Houston for weather reasons, Texas hardly noticed that there was a recession in the past 10 years. They were not hit very hard at all. And I think it's useful that you ask the question about geography, because geographically the intensity and the timing of the recession do vary by whatever demographic and economic factors happen to comprise that particular part of the United States. And so what happens on the West Coast is going to be probably different than what would impact, say, the state of Florida or the New England states.
Right. That makes a lot of sense. Dev, what industries are not so vulnerable to the downturns? We talked about the ones that are impacted, but are there industries there that are kind of downturn proof?
Well, yeah, let me start with local, state, and federal government. Regardless of whether we're in good times or bad, construction for governmental facilities seems to go on. And of course, the best news about that is our source of repayment is essentially taxation of the citizens. And certainly during the Great Recession, the Washington, D.C., Northern Virginia area, you could hardly tell that there was a recession on in terms of the construction activity. And of course, if you turn the clock back to 2008, 2009, during the Obama administration, when that administration was touting shovel-ready projects, road building, bridge building, and the like, the governmental sector seems to, by and large, weather recessions reasonably well. You don't hear about too many cutbacks in government workers during the recession. The other interesting cluster of relatively recession-proof industries are what I would call R&R, relaxation and recreational. For example, liquor stores, bars don't do too badly. You may not be buying top-of-the-line vodka. You may give up Grey Goose for a pop-off. You may skip the imported beer for a Bud Light, but that business seems to do reasonably well. And then when you kind of expand entertainment beyond football games and basketball games to museums or other cultural events, they seem to do okay as well. So the movies seem to be fairly recession-proof. You may not find the goodies as the array that you might have before, but anything that's tied to the government, anything that is a necessity, what I'll describe as the grocery business, supermarkets, you have to eat, you have to drink. And so you may not be buying brand name foods and beverages, but that business manages to get by as well. So the tip would be looking at your portfolio and then highlighting or identifying those that are highly vulnerable to recession and those that are not so.
Gotcha. And how about doctors, dentists, healthcare? Would that be another one that could potentially fare better during a downturn?
Yes, good point. You still have to go to the doctor. You still have to go get your leg set if you break it. It's just that for the businesses themselves, it may take them a while longer to collect.
Right.
But anything that I would classify as a necessity would do fairly well. You might argue that plastic surgery and some of the not so important surgeries would maybe do as well. But again, if it's a necessity, it will get through the recession.
Makes sense. Well, most importantly, can you share with us what steps should a bank take to prepare for a downturn?
Yeah, in my list of diagnostic tools and checklists, I think the first thing would be in terms of portfolio management. As I said a little bit earlier, Mike, this is where you start identifying those businesses that are sensitive to recession, those that are not so sensitive. And I didn't mention it, but I would add to that list anything that's tied to export or import. So if you've got a customer who exports to a particular country, like China, chances are pretty good that they're not doing so well. Or if they import from another country, I'm reminded that here in Atlanta, there's a Persian carpet retailer who is going out of business simply because he can't get Persian carpets anymore from Iran. So the other related to export-import would be anybody involved in moving the goods in or out. So everyone from tugboats to warehousing at port harbors would also be examples. After you've gone through sorting your portfolio into vulnerable and not so vulnerable, then the next step would be taking a look at your policies on limits and making sure that if you've set a limit, for example, on commercial and industrial, are you getting close to it? And making sure that you're administering it appropriately, looking at your risk ratings, particularly the element in the risk rating relating to industry risk. And there are several vendors out there that offer you regular periodic updates of relative risk of different types of industries, which would be another way of backing up that split between vulnerable and not so vulnerable. And a third item on my checklist would be taking a hard look at your problem asset management. Do you have a group ready to go to handle the inevitable increase in problem borrowers? Is your policy up to date on problem asset management? Most banks, once a borrower goes a substandard, it goes automatically to problem assets. You might want to think about, and special mention, requiring the sign off of a problem asset manager while still allowing the line to manage it. But getting that input from problem asset management now is a smarter thing to do than later.
That makes a lot of sense. In that same thought, I think communication with the customer, once you identify those segments and those customers, early communication to try to identify those problems before you're really deep in that downturn would be important as well, right?
Oh, yes, definitely. This is why the risk rating process is so important. You're supposed to update them at least annually, but if you've gone ahead and identified the vulnerable companies, this is where you'd want to communicate to the lenders handling them, and it might be worthwhile going and talking to them, find out how things are going for them. So again, if they export machinery to China, how are they handling it? If they've lost those revenues, what are they doing to replace them?
Right.
As an example.
Right. This has been great, Dev. I got a question for you now. It's, one of the things that we try to do on this show is ask leadership questions as well. And I know you've worked in many institutions and been a manager of some great departments over the years. And so I wanted to ask one of our Elevate leadership questions to you, and that's, what's your secret sauce? So what would be 3 leadership principles that have contributed to your success through your career?
Well, let's see. First one is, even though you think you can do it yourself, you really can't. And so gather whoever works for you, let them do their share of the work for you, and in essence, delegate. And then second, and I'll give you an example. I was a chief credit officer at a bank, and I had credit officers in our regions. And the other thing that you need to do is back them up, because as soon as they make a decision that is not liked or not popular with whoever, for example, maybe they said they'd only do this loan if it had this loan to value or these guarantors, and you get that inevitable call from the lending manager. And this is where, you've got to say, Charlie made a decision, and I believe he did it appropriately and correctly. Because if you're going to delegate, in order for it to work, they also have to have the power to be able to enforce their decisions at delegation. And then if there's a third one, it's really related to when I was running credit policy. I can look at something and see, a couple of loopholes or gaps, but I discovered very, very quickly, the more people in the room, the more ideas that get generated. So if you say, for example, so if we increase the loan to value in real estate from 75 to 85%, what's the downside? What's the unintended consequence? And encouraging people to offer their opinion, and then making it clear that you not only appreciate that opinion, but you're taking it into account, and then giving credit where credit is due, I think, is really what makes for a good relationship. So delegate, back up the delegatees, and get their opinions and take their input and give them credit for where it's due. Is kind of an easy 3-step process, I think, that makes for better management all over.
That's great. Thanks for sharing that with us. Yeah. So Dev, as we're wrapping up, how can people get a hold of you if they want to look at more information that you've got out there or contact you?
Sure. They certainly can find me. Probably the easiest place is LinkedIn, and I've got a page there. And of course, they can Google, and if they Google my name, they'll find me. They'll find several ways to get a hold of me. They certainly can contact you at Elevate Bankers. And for those people who just want to cut to the chase, you can get me at Dev.Strischek at devonrisk.com.
Fantastic. Well, Dev, this has been great. Thank you so much for joining us today. And I'm looking forward to having you as part of our program in Las Vegas next April, where hopefully you'll be doing a lot of the lending training for our folks that'll be out there. And maybe we'll even get some real surfing in next year in Hawaii at the Elevate 2020 conference. I'll put Dev's contact info as well as some information and articles that he's done on the business cycle on the episode notes page. Dev, thanks so much for joining us today. And we will see you next time on Elevate Talks.
Thank you, Mike. Bye-bye.
You have been listening to Elevate Talks, a weekly podcast created with the Elevate mission in mind, which is to educate, connect, and inspire bankers. For more information on Elevate, go to ElevateBankers.com, where you can find show notes from this episode and learn all about our 2020 conferences specifically designed for banking leaders. And don't forget, the Elevate Bankers Conference will be held April 14th through the 17th in Las Vegas, Nevada. Visit ElevateBankers.com and register today for this one-of-a-kind banking program designed for bankers in the areas of compliance, technology, finance, lending, marketing, and human resources. I'm your host, Michael Delucchi, and I hope you subscribe to our podcast. And until next week, I will see you at the top.